Good evening to all of you. Good evening.
Good evening.
So welcome to our revision classes. Okay, and my suggestion is that we try to go through the syllabus. Okay, we pinpoint, or rather, you pinpoint the areas where we need to pay more concentration. So our attempt to go through the syllabus. Okay, of course, in a very summarized fashion. As well as we attempt to do the mock together. Okay, so in case, for example, we discuss topic 1 and there's a question from the mock, okay, or from in the source, okay, which you think you can discuss at topic 1. When we discuss topic 1, then we shall therefore be discussing it at that point in time. Okay, so as much as possible, don't forget you're the one to guide this revision. Okay, so you're the one who is meant to guide this revision. As much as possible, because there's nothing new I'll be teaching as per se. So those areas where you think that you require more time, you require you require more time, then I'll begin. That's when we discuss it. So bring up with many questions from past paper, from the mock, okay, from the cut, when you're done, okay, from whatever source, okay. Yeah, so it's so that you answer it at that point in time when doing the revision, okay. That's what I suggest, okay, that we can do, okay. Okay, so let's begin off with topic 1. Okay, topic 1, although we discussed, was simply an introduction towards, okay, was simply an introduction towards financial management, okay. Okay, topic 1 was an introduction towards financial management. It was an introduction towards financial management. Okay, where we see that at the end of the financial management is simply the managing of company finances, the managing of company financial resources in order to see the company achieve its ultimate objective.
Excuse me, sir.
Yes.
Before you start, there was a question on Islamic finance in the mock. I'm not sure whether we covered it during the lesson.
Okay. What I'll do, I will have some few notes here on Islamic finance, which I think I will share with you, as well as maybe on the dividend policy, okay, which is not part of the syllabus, but I'll share with it. But Islamic finance is part of the syllabus, okay, so I'll share the notes that I have with you, okay, so I'll share the notes that I have with you for sure. Thank you. That's okay, Mary?
Yes.
Okay, great. So I'll share with you, hopefully before the end of today. So on topic 1, therefore, it was simple introduction towards financial management. Okay, so that financial management is the management of company financial resources with the key purpose of assisting the company achieve its ultimate objective. Okay, and so that the objective of the firm, okay, we can classify them into my category. Rather, there are 2 core decisions, okay, that need to be done. There are 3 core decisions that need to be done, that need to be covered, okay, that need to be done, okay. When you say that you're doing financial management, okay, what does it entail, okay? So it entails 3 things, okay. One is on the investment decision, okay. Then you have financing decision, then you have dividend decision. Give me a second. There's something we need to sort out here. So if investment decision, financing decision, and the dividend decision. So those are the three core decisions that we covered at the financing decision. Okay, financing, investment, and dividend decision. For investment, simply is about the appraisal. Okay, trying to determine where should the company put its money in. Okay, which is the value added investment that as a company we ought to invest in. So the appraisal of the investment. Okay, should we continue the investment? Should we discontinue it? Okay, should we replace the machine? So all that is at the dividend investment decision. Finance decision, don't forget all these projects that you want to put your money in, they will cost you money. So the idea is that you want to determine where will the money come from, okay? From equity, from debt, from private share, okay? What's the cost of using debt, okay? What's the cost of using equity? What's the cost of using preference shares, okay? So also determine the cost of capital from each of those finance sources, okay? What will be the interaction of the financing alternative we want to take with compared to okay, the current financing we already have. Okay, if we have to use more debt, what does it mean regarding our gearing? Okay, if you have to use more equity, what does it mean? How does it imply regarding our gearing? Okay, so all those questions you need to answer should be answered at a financing decision. The dividend decision, the dividend is the return the shareholder will be receiving, the payment, okay, the distribution of the company earnings the shareholders, okay, is referred to as the dividend decision. Okay. Don't forget the three decisions, as we mentioned, they are in collaboration with each other. Okay, that there's none. So one of them, these decisions, they'll be affecting each other. Okay, if you make the investment, definitely you need to look for financing, and definitely at the end of the day, you'll be having earnings upon which you're going to be able to pay to the shareholder the dividends. Okay, if you make the investment, of course, that means for or in case there's no financing, then you can't invest. Okay. Then you can't pay the dividend because there's no earnings. Okay, so it's well enough you look at the interaction of these three core decisions. And the objective the farm want to achieve, okay, we say that when it comes to financing decision, when it comes to financial management, okay, the money to company resources in order to achieve certain objectives, certain targets, okay, and this we say they are going to be, okay, I will call financing, what we refer to as financial objective, okay, financial objectives, and here we call the non-financial objective, okay. The objective the company want to achieve are both financial and non-financial, okay. For the case of non-financial, okay, we say that these are objectives that the company pursues, because at the end of the day, the evaluation as to whether they have been achieved or not, okay, the evaluation as to whether they have been achieved or not is getting based purely on a non-financial metric. Okay, when it comes to the evaluation of whether we have achieved it or not, then again using a non-financial metric. Okay, a non-financial metric. Okay. Then when it comes to financing decision, when it comes to financing decision, okay, we did say that when it comes to financing decision, we did say that these are the objective the company is pursuing, whose objective, okay, finance decision again, whose objective at the end of the day, okay, is to see the company, or rather, whose the achievement of this objective, will be evaluated, okay, using a financial metric. Okay, the achievement of the objective will be evaluated using a financial metric. Okay, for example, okay, the company profit maximization. Okay, the company profit maximization. This is a financial objective. Okay, this is a financial objective. Okay, because at the end of the day, when we will be evaluated whether this has been achieved or not using the profit. Okay, as the benchmark. Okay, the net profit or gross profit. Okay, as the benchmark. Okay. So at the end of the day, the evaluation of whether the objective has been achieved or not is based on a financial assessment. Okay. However, we said this objective has its own limitation. Okay, for example, it's an ambiguous goal. Okay, it's vague. Okay, it's not long term. Okay, profit can be manipulated by the management. Okay, so all these mean therefore the company was to try to pursue another objective that doesn't have this limitation, so that doesn't have these disadvantages more or less. Okay, therefore that's the company pursue what referred to as the wealth maximization. Okay, the wealth maximization. So the wealth maximization, don't forget that the objective of the managers, the one who will be running the company, should be ensuring that their decision that they make, okay, is geared towards maximizing, increasing the wealth of shareholder. Okay, maximizing, increasing the wealth of shareholder. Okay, and instead, when it comes to the evaluation of the wealth of shareholder, okay, we normally say that the shareholder's wealth the shareholders wealth, okay, is given us, okay, P1 minus P naught, okay. We do a P naught, okay, and this we'll call the capital gain, gain, okay, plus D divided by P naught, okay. This is referred to as the dividend yield. Okay, this is what we said regarding the wealth shareholder. Okay, this is therefore shareholders wealth, return to the shareholder. Okay, P1 minus P naught divided by P naught. Okay, this gives therefore capital gain component plus the dividend yield. Okay, to give therefore total return to the shareholder. Okay, that's why we say that we make an evaluation as to whether the company management are maximizing the shareholder. Okay, we also say that you can also have the growth in earnings per share. So earnings per share growth, earnings per share growth, okay, can be another objective the company can pursue, the earnings per share growth. Okay, with earnings per share, we see that earnings per share is given us the net profit most of the time to be the net profit, or in case the company is paying some return to the preferred shareholder, earnings attributable to equity shareholder, we divide by the number of equity shares. Okay, that gives the earnings per share. So you can make a comparison. What was the earnings per share last year? What was the earnings per share this year? Okay, what was the target? Okay, if for example earnings per share this 2019, okay, was let's say $10. Okay, then this year, okay, 2020 earnings per share is equal to 11 shillings. Okay, then you can make a comparison. The growth between 2019 2020 is equal to 10%. Okay, that's the growth. What was the target earnings per share? What was the target earnings? Sorry, my pen is misbehaving. So we're comparing, okay, this is the actual growth in earnings per share, okay, we make a comparison. What is the target earnings per share growth? Okay, if the target was 20%, then now you can critique the management. Hey, if the actual is 10%, what we had agreed with you as management was a 20% growth in earnings per share. Apply therefore the management are yet to achieve the objective of growing your earnings per share by 10% within a year. So therefore you can now be able to critique the management. Hey, we're not going to give you any bonus because you didn't achieve what was agreed upon objective. Okay, and those are three key financial objectives that a company can pursue. Okay. There's a question that your examiner can do. So I'll try as much as possible. We don't do a question which you've done in class together. Okay. So try as much as possible. But in case you do have a question which you think that it was enough for us to redo it, there's no problem. Okay. I have no problem in redoing a question you've done already. But I would propose, if possible, we look for an alternative. So this one, once you can get it. This one that the examiner was asking you to get a return of a portfolio. Okay, I think it's a question. You get a return to the shareholder, then you get a return of a portfolio. Let's see if I can get it. Okay, I hope you have not done it. Let's hope you have not done it. Let's see how to get the question. So June 2013, question 3. Here, okay. So here we need to get, you're going to be using absolute return. We simply P1 minus P0, okay, to give you the capital gain plus the dividend, okay. You can do that for X. For X, this will be equal to P1 is the share price end of the period, which is 34, minus share price beginning of the period, which is 30, plus the dividend paid, in this case 3.4. Together for return for X, for Y the same thing, share price end of the period 69, share price beginning of the year 72, the dividend paid 4.7. Z, the same process, okay. Return will be equal to share price of the period 146, share price beginning of the period 140, plus the dividend paid during the period, which is equal to 4.8. Okay, do that. You get how much X? What do you have?
7.4.
7.4. Y, you have?
1.7.
1.7. And Z?
10.8.
10.8. Okay, 10.8 for the return of each of the share on or using absolute terms. Okay. Now, in terms of percentages, we'll call relative return. Relative return. Okay, for X to be equal to 47.4. So we don't need to work it again because we already have the return here. Don't get to be equal to the absolute return. We just give the formula, which I've already done either way. P1 minus P0, okay, plus D divided by P0, because we express as a percent. Okay, therefore X to be equal to 7.4, which I have obtained here already. We divide by the share P1, P0, which was 30. We express as a percent. Okay, Y will be equal to 1.7 here, divided by the share price within the period, which was 22. We express as a percent. And the same apply for Z, will be equal to 10.8. We divide the share price beginning of the year, which was 140. We express this as a percent. We get how much for A, for X, Y, and Z?
X is 24.67, 2.36, 7.71.
Okay, because for return to the investor, if they invest in X, in Y, and Z in percentage. Okay. Then in 3, we meant to get the return of the portfolio if you have to invest 4 in the ratio of 4 to 4. Okay, that is ratio 4 to 4, total 10. Okay. Therefore, in X, therefore, the return of the portfolio be equal to the return received, the weight of X, which in this case 0.4, okay, times the return 24.67%. Okay, weight of Y 0.2, which is 2 out of 10. Okay, times return 2.36. Return of Z, which is 10.71%, times the weight of Z, which is 0.4. Okay, and you get how much?
%13.42%.
13.42% on the return to be received if the company was to invest in X, Y, and Z in those proportions 4, 2, and 4. Okay, so that's on how to get the return, on how to assess or evaluate the return to the shareholder. Okay, and that was more or less in topic number 1. Question? Okay, great. Topic 2. Topic 2 was more towards explaining on the money or on the financial market. Okay, where do we obtain money from? Okay, and you see that when it comes to financing, we can obtain money or the market under the market for funds. Okay, where you can obtain the money, we can classify the finance source in 2 main categories. Okay, we have financial market. Okay. You have financial market and you have financial institutions. Okay, so you can classify a market for funds, okay, and financial institutions. When you say the key difference between these two was that when it comes to obtaining money from the financial market, okay, we are going to be having the person who is in need of capital, okay, which is we can call the borrower, okay, is going to be in contact, okay, with the person who has surplus capital, okay, as lenders, okay, directly, okay. So there's not going to be an in-betweener, someone who's going to be come in between the two. So more or less, the company or the one in for capital will go directly to those who have surplus money, okay, and they'll do so through an issue of most of the time financial instruments, okay. So it will be in return, give me my money, then return will give you a financial asset, for example, equity shares, okay, for example, bonds, okay, for example, commercial papers, okay. So at the end of the day, okay, in return for the capital, okay, there will be a financial asset, a financial instrument that is going to be issued in exchange, okay. So you see that on the other hand, when it comes to financial institutions, okay, there will be what we call the surplus, okay. Let me just do a simple graphic. So here we have in here surplus, surplus units. Those are the one who have more money than what they need, okay. And here you'll be having the deficit unit. Okay, and you see that the money is going to first go through a financial intermediary, then the borrowers, okay, in this case, the deficit units, these are the borrowers. They won't go to the surplus unit, they'll go to the financial intermediary to obtain the capital, okay? So this is going to be, okay, lending of money, and this is the borrowing of money. Okay, that's key distinction between those two. Okay, what imply therefore, in the case of financial institutions, okay, we're not going to have the surplus units going to invest directly to the deficit units. No, okay, these occur in the financial market. This occurs in the financial market. Okay, this occurs in financial intermediary, or what we call the financial institution, at the financial institutions. Okay. So that's on the two, okay, financial market and financial institutions. So here the example can be one of key examples is the banks, okay, your pension funds, okay, we have insurance company. What else we have? We have circles, okay. So all these examples of financial institutions, okay, as per se. On the financial market, we can further classify it into, okay, we can further classify it into, we have what we call the money market. And you have the capital market, money market, and you have the capital market. And the key difference here is the financial instrument that is being issued here. Okay, don't forget here, this is going to be the flow of capital. This is capital. Okay, in turn, there'll be the financial assets. Okay, in turn, there'll be financial asset here, financial instrument. Okay, so in turn, don't forget, as I mentioned, this financial instrument, financial assets, okay, if their life is going to be not more than one financial year, okay, less than or equal to, okay, less than or equal to 1 year, okay, then notice that the transaction is occurring in the money market section. Okay, if here the instrument that they're being used to obtain the capital, this instrument here, okay, is going to have a life of more than one financial year, okay, life is going to be greater than 1 financial year, okay. The transaction therefore is occurring in the capital market section of the financial market. We give examples that here you can have, for example, commercial papers being one of them, commercial papers, okay, repurchase agreement, okay, we can have here T-bills, treasury bills. What else can you have? The money market. Certificate of deposits, banker acceptance, okay. And if you remember, I told you, you go try to get notes on them, okay, on your own individual capacity, okay, just to get to have an idea. But sometimes the exam can ask you, what is a commercial paper, okay, what is the purchase agreement, okay. So I think I told you this, okay, and I hope you did this. If you've not done it, please do before the exam. So that's on the money market instrument. In the case of the commercial, in the case of the capital market, the instrument that can be issued, we have bonds, okay. You have the case of equity shares. You have the case of preference shares. Okay, so all this can be one of the instruments that have a life of more than 1 financial year. Okay. We also did say that you can also classify the financial market. You can also classify financial market also into main category. Okay. You can also classify the financial market into 2 other categories. That is primary market. That is primary market. And you have the secondary market, primary and secondary market. Okay, and so the key distinction between these two, the primary market and secondary market, it's if the instrument, okay, this asset here, okay, is being issued for the first time ever, okay, for the first time ever, the transaction is occurring therefore in the primary market of section, primary market section of the financial market. If this instrument has already been issued, it was issued in 2013, okay. However, its subsequent trading, its subsequent transactions occur therefore in the secondary market. So the subsequent, okay, issues, therefore, subsequent trading or transaction, okay, of this particular financial asset, financial instrument occurs therefore in the secondary market section of the financial market. Okay, that's what we discussed under the financial market. Question. Well, that was on topic 2. Okay, I beg you to kindly go get to know, have more material on this. Okay, have more material on this. Okay, because you never know. The examiner can decide to ask you to explain one of those maybe money market instruments. Okay. Question on that topic. Okay, no question. Great. Topic number 3 was on working capital. Topic 3, okay, was on working capital. Okay, it was on working capital. Okay, and instead of working capital, this is the funds, okay, that is required by the company in order to run its day-to-day operation effectively. Okay, the capital, the money, okay, that the company requires, okay, in order to run its day-to-day operation effectively is what we refer to as the working capital. Okay, and instead, when it comes to the management, when it comes to working capital management, then as a company, you need to ensure that it achieves 2 purposes. Okay, one of course is to make profit. Okay, the profitability objective, okay, and of course you also mean to ensure you do remain liquidity objectives. So the 2 objectives that the company pursues, okay, when it comes to the management of working capital, we want to make profit. That is, every investment that we have made towards the working capital, towards the assets, towards the current assets, for example, they do make returns for us. They do make positive returns for us. Okay. However, at the same time, you want to ensure you do remain liquid. What does that mean? It means as a business, as a company, okay, you should be able to pay for your obligations as and when they do fall due. Okay, so you want to achieve those 2 things when it comes to working capital. Okay, however, there could be what we call mismanagement in working capital. Okay, that it is possible that there could be working capital mismanagement. Okay, but before you do that, we need to say that the company net working capital is the excess of current assets is equal to the excess of current assets over current liabilities minus current liabilities. Okay, we need to say that it's not a must for it to all be positive. Okay, if involved in manufacturing, okay, we need to say that most of the time you'll be having or should be having your working capital as positive. If you're more to a service-oriented company, then most of the time you'll be having your working capital as a negative. Okay, so it's not a must, okay, for it to be positive or negative. Okay, so it can either be a positive or a negative based, for example, on the nature of the business you are in, based on the industry, okay, the nature of the operations you are involved in. Okay, so you see that we may want to make an evaluation of how effective the management is when it comes to working capital management. Okay, we want to evaluate how effective are you as a business when it comes to working capital management. So you can list a number of issues, and one of them was the use of the company, what they call the cash conversion cycle and the operating cycle, the cash conversion cycle, okay, and the operating cycle. Okay, we see that the cash conversion cycle, okay, is given us, or what is it? It's the number of days that you take as a company from the time you paid your suppliers, the time you get the money from your customers, all that time difference. Okay, that was the cash conversion cycle, or simply the cash operating cycle. From the time you pay your suppliers to the time you get the money from your customer, all that time difference. Okay. Now, in the case of the operating cycle, this is time that it takes from the time you start production all the time you receive money from the customer is referred to as the operating cycle. Okay. Therefore, it's given us the number of days for inventory, the inventory days. Okay, these are days. Okay, plus the days for receivable. Okay, the sum of this will give therefore the company operating cycle. The company operating cycle. Okay, then if we less payables days, if we less the payables days, we get a cash conversion cycle. Okay, we get the cash conversion cycle or the cash operating cycle. Okay, because therefore we can use this to evaluate the company is doing well or not. Okay, both the use of the cash conversion cycle and the operating cycle. If the company is over in manufacturing, okay, therefore we do expect that now the number of days to be positive. Okay, the company is over in manufacturing, which implies that if the days are increasing, then it might be an indication of the company becoming ineffective when it comes to working capital management. Okay, so you can observe, okay, compare maybe the industry, you compare with the company past data to make a comment. Okay, are we better off in terms of managing working capital, or are we worse off? Okay, so the use of comparing the cash flow cycle with the industry or comparing it with the other firms, okay, or with the company past history. Clear? And this is that the number of days, okay, is given us. Okay, the number of days for inventory is given us. Okay, 365 or 360. Okay, whatever it is, we multiply by the inventory. We divide by the purchase made on credit. Okay, the purchase that was the total purchase of inventory made during the time period. Okay, but most of the time we use the cost of sales. Okay, to get the number of days for receivable, 36, 35, we multiply by the amount the company is invested towards the customer for goods or sold on credit. We do a total sales made on credit sales. To get the payables, 360 or 35 multiplied by the payable, the amount the company owes suppliers at a point in time. We divide by purchases that are made on credit, okay, or simply the company cost of sales. Okay. So fair enough. I think we can do a question quickly. I don't think in the MOOC there was a question, but let me see. If there was, then we can do one question. We do it quickly. I don't think there was a question, but let's see. Not so sure about that. Okay, there was none. There's none. So let's see if I can get one. One, we meant to get the company cash conversion cycle, and if possible, a question we have not done. So assist me to get the question, okay, from your question bank. You meant to get the company cash operating cycle. The company okay, so we've been asked to get the cash conversion cycle for this particular company. Okay, so we get the days for inventory, days for inventory days. You meant to use some days in a year, 360, it'll be 360. We multiply by the average inventory, the average stock is 2 million. We divide by the total purchase made for the year, not total. So therefore, in this case, therefore, we use the cost of sale, and we told the cost of sale, the gross profit margin is 40%, okay, which means therefore, if all sales in an year is 10 million, the cost of sale is 60%. Therefore, cost of sales for this company is 60% because the profit is 40. 60%, we multiply by 10 million and get 6 million. Therefore, we divide by 6 million, which is the cost of sale, and get 120 days. Okay, then we add the days for receivables days. that is 60. We multiply by the receivable investment, which is average debtors, which is 66667. We divide by sales that remain on credit. We assume that all sales are on credit. Actually, it's given to us in note 2, which is 10 million. Then we less payables days, which is equal to 360. We multiply by the average creditor, which is 800,000. We divide by the total the cost of sale, which is 6 million. Days for receivable is how much, therefore?
$24 days.
So in 4 days, okay. Days for payable,
So it's 24, not 70.
sorry, 24 days, 24.
24, yeah.
24 days, okay. Payables days,
$48.
minus 48 days. Do you guys have all the cash conversion cycle for the company? 120 plus 24 minus 48, 96. Confirm 96.
Yes.
Okay, you get 96, therefore 96 days therefore to be the cash conversion cycle. Okay. Then what else? And then this one, another one which I don't know whether I've done this together. June 2011. Tell me that you've done it. June 2011, question 1C. June 2011, question 1C. Have you done it?
No.
Okay, great. Okay, then I'm sharing a question with you. Okay, go through it. We discuss together. Great. So we need to get the operating cycle and cash conversion cycle. So therefore, we need to get the day for inventory, days for receivable, payable. Okay. So we begin with the getting the days for inventory. Should be quite easy. This one for sure. Should be equal to the number of days in a year. 360. We multiply by the average inventory. Be careful. We use the average inventory, and the average inventory, average stock, average inventory will be equal to the beginning balance 17,340 plus end balance 15,960 divided by 2, and you get how much? $16,650, therefore 16,650 we divide by the cost of sale, and the cost of goods sold is 92 million, therefore we divide by 92 million. How many days therefore inventory? we do quickly so that we proceed to the next area. What do you get?
65.
65 days. Okay, get 65 days. Okay, the same for the days for receivable. The number of days in a year, that is 60, times the average receivable. So here, average receivable will be equal to 42 to 40. Okay, we add that 520 to the average receivable, divide by 2, and get how much?
$39,880.
That's 9,880. We divide by the sales that were made on credit. So we assume all sales on credit, 120 million. So these are in thousands, honey. These are in thousands also. How many days for receivable, therefore?
$11.96.
Sorry, how many days?
$11.96.
How can it be? Get the 360 times that's 9.88 million divided by 120. What should we get? 1196 or 120 days?
120.
Yes, 120 days. So check your work in Mary, I guess. Okay, this is that's 9.8 million out of we divide by 120 million. So it can't be beyond 360 days for sure. Okay, so we get therefore 120 days. That would be the days for receivable. Then we less the days for payable. So less payables days. Payables days. We got to the number of days in a year, that is 60. We multiply by the average payable. So here we get average creditor is equal to the balance beginning of the year, that 510 plus end of the year, 27, 3070, divide by 2. And get how much with the average?
$31 for 40.
1 for 40, therefore, that 1.44 million. Divide by the cost of sale, the cost of goods sold, which is 92 million. And get how many days for payable? One what?
123.
103 days. Get 103 days. Okay, great. Therefore, the question is to get the operating cycle and the cash conversion cycle. Therefore, so the number of days for inventory days, which you got to be equal to 65. Okay, plus the days for receivable 120. The two give us the operating cycle, which is give us 185. The current continues. We need to get the also the cash flow cycle. Therefore, we less payables days. Payables days, which is equal to 1 minus 123 days. To give us how many days?
62.
Yes, 2 days therefore to be the cash convert cycle for 10 marks. These are free marks, which of course I guess you should be able to get. Okay. Question. Okay, great. Sometimes the examiner may ask you to do what we call a working capital estimate. Okay. In the working capital estimate, okay, what may happen is that you have the number of days given to you, so you're meant to work backward. For example, you're given the days for inventory to be equal 65, so you need to work backward and get the inventory, the average, the inventory investment. So you need to work backward and get the average, you get the inventory that the company need to invest. Okay, so can you do that? For example, a case where you give the days, so it's upon you working backward and you get therefore the amount that the company need to invest towards inventory, towards receivable, towards payable. It's the same concept here, but we need to work backwards. Okay. We'll call estimating the company working capital requirement. Okay, I want us to do we do that area through a question. Okay, where you're meant to estimate the company working capital requirement. So let me get a question which can help us in doing that. I'm not sure that we've done this, but in case June 2010, question here from June 2010. Question 3A. Have we done it? June 2010, question 3A.
No.
No, okay, fair enough. So let me take a screenshot. You go through it, then we discuss together. Okay, so the question is a statement. So the question is required. And let me just take a photo of it. Okay, so that's required there. A statement showing working capital estimate. Okay, so suppose we're going through it. You meant to show a statement of working capital estimate. Okay, so you're given the days, so it's about working backward and get the amount the company need to have invested in each of those accounts. Okay, so they can begin with note 1. The finished goods in stock they are in stock for 1.5 months. So therefore, we can get therefore what was the finished good investment in the company? Therefore, finished goods. Okay, therefore, will be equal to the number of days which you have been told in this case is equal to 1.5 months. Therefore, it will be 1.5 out of 12. We multiply by the amount the company, the cost of goods sold. The total cost per unit you've been told is equal to 221. Therefore, this will be equal to 221, we multiply by the number of units. In a year, the number of units is 100,000. Therefore, equal to 100,000. Okay. Therefore, the finished good investment. Okay. Then we do next note. Okay, is raw material. I mean, how much the company need to have invested towards raw material. The number of days for raw material is 2 months. Therefore, 2 out of 12. We multiply by the total purchase made. In this case, 104 times the number of units per year, 100,000. Okay, that's for raw material. Then you have the finished goods, raw material, finished goods, work in progress. The amount the company has invested towards work in progress. Okay. Will be equal to the number of days for work in progress, which is 1 month. 1 out of 12, we multiply by the work in progress is valued using what? Because for work in progress, the valuation might be different. You're not being told what's the valuation for work in progress. Work in progress. There's no note on work in progress because I'm not going to have a case of work in progress being valued at maybe half raw material 100% complete. Okay. Anyway, so we assume that they're all complete, which of course doesn't make any sense. Wish the examiner had done that, telling us to what extent is the work in progress complete. Okay. Anyway, we just use total cost here. Okay, so it doesn't make sense. 221 we multiply by 100,000. Therefore, the total amount the company need to invest towards the goods, towards the inventory, finished good, raw material, as well as work in progress. Okay, we do that for the case of a receivable. Next is on the receivable. Okay, the amount the company need to invest towards the receivable. Okay, as per note 5, the days for receivable is 3 months. Therefore, 3 months out of 12, we multiply by the total sale made during the year. Okay, in note 8, a quarter are on cash. Therefore, a 3/4 they're on credit. Therefore, 3/4, okay, we multiply by the selling price per unit, which is 260, times the number of units sold. In this case, 100,000. Okay, note 8, a quarter on cash. Therefore, 3/4 they're on credit. Okay, that's for the receivable. This is the same for the case of payables. Okay, and for payables, there are 3 payables. We have wages, we have overhead, and we have the supply of raw material. So here, payable. We begin the payables for suppliers for raw material. Okay, raw material suppliers. We determine how much do we owe them, raw material suppliers. For material suppliers, the number of days as per note 4 is 2 months. 2 months out of 12. We multiply by the amount that you have bought for them on credit. So no mention on what the extent of supply that are on credit. So we assume that all of them are on credit. Okay, all of them are on credit. Therefore, they are 104. We multiply by 100,000. Again, for the amount the company to invest towards the raw material. Then you have other suppliers for wages. In this case, these are employees. Okay, employees. The amount we owe the employee on average basis. In note 6, we owe them in half a month. Therefore, the number of days is half a month. 0.5 out of 12. We multiply by the amount that we have purchased from them, their labor, which is that's 9 per unit. We multiply by 100,000. Then you have suppliers for overhead as per note 7. Overheads. Overheads, you've been told that on average we pay them for 2 months. Therefore, 2 out of 12. We multiply by the amount you bought for them, which is 78 times 100,000, the number of units in a year. Therefore, all those are suppliers for the payables, raw material, wages, and the overhead. And you're done with workings. I don't think there's anything else you're not done. Okay, fair enough. Get the investment required in each of those accounts.
Oh, finished goods is 2,762,500.
Sorry, finished goods, what do you get? Someone was making a comment.
It's 2,762,500.
Sorry, I lost you.
762,500.
500, that's for finished good. Raw material.
1,733,300.
703. 700.
333.
303.
Yes.
Okay, work in progress.
1,841,841.
So 1,000,008.
841.
841.
666.
Receivable.
4,875,000.
Payable for raw material.
1,733,333.
Okay, payables for wages.
162,500.
Payables for overheads. Payables for overhead.
1,300,000.
1,300,000. Okay, so we're done with all the workings. Therefore, now we can be able to prepare a statement. Okay, enough. Now we can prepare a statement here. So this is February company. Statement of working capital estimate. Statement of working capital estimate. Okay, can begin current assets. Can begin with the inventory. And this is the inventory with raw material. Inventory as per the working you have just obtained the raw material is 17,333. Then you have work in progress, which is equal to 18,4166. Then you have finished good. And the finished goods, we will be able to get them to be equal to 27,62,500. You have the three give us total working total inventory. Then you add receivable, part of current assets, and the receivable from our calculation we got 48.75. 48,75,000. Then you have cash. This is as per note 9. The company has a cash balance of 240. You have plus 240. They give us therefore total current assets. Okay, so of course we less the company current liabilities. Okay, so here we have payables. Payables for raw material suppliers. The material suppliers, we owe them as per the working you have just done. The material supply is 17,333. Okay, suppliers for wages. In this case, the suppliers for employee, the employee that is, okay, that is wages. The amount you owe the employee on average basis from a calculation you obtain is 162,000. Then of course we list these suppliers also for overheads. This is payables towards the overhead, which from calculation we got 1.3 million. Okay, so we get the total. Then the net, we get net working capital. The cost will be the payable. Okay, then the current liability, current assets minus current liabilities. And you get how much? What's the total current assets?
$8,256,600.
For cash, for current assets.
No,
Get-
the total net working capital.
Okay, okay. How we have the okay. First, given the total current assets. Total current assets how much?
11,452,499.
52,000. 499. Okay. Then current liability total. 3 million.
195.
195.
833.
833. Okay, therefore, 11,042,000 minus 3 million, you get how much? As a net working capital.
$8,256,666.
Okay, positive, that is.
Yes.
Okay, because for the company net working capital, that's how you prepare a working capital estimate, statement of a company, a net working capital. Question?
Could you kindly scroll up, sir?
We are now
From the beginning.
from the
table.
From the table. That
Yes.
there.
Up.
The two begins there.
Yeah, from there. Thank you. Just from there.
Okay.
Screenshot.
Done.
Yes.
Okay, great. Okay, so therefore we prepare. Any other question? Okay, another question. That's why we prepare a statement of working capital estimate. Okay. So let's go therefore to on how we manage working capital. Okay, how we manage the individual component of working capital. Okay. So when it comes to the inventory management, management, we see that when it comes to inventory management, the idea is that we want to establish what should be the company or what should be the optimal amount the company should be investing towards the inventory. Okay, we don't want to have a case of over investment. Neither do we want to have a case of under investment. We don't want to have to tie down most of our capital, okay, towards inventory, or tie down or have a case where we have inventory stock out. Okay, so therefore, what should be the optimal that the company therefore should be investing towards the inventory. Okay. That's what we want to establish. And so that's one of the models we can use, okay, that can help us in getting to know the amount we should, for example, we should be ordering to make the optimal amount we ought to be reordering is the EOQ, okay, the EOQ model. This is the EOQ model. The Q is equal to the square root of 2 annual demand cost per order. We do a holding cost per unit per year. Okay, that gives therefore the optimal reorder quantity. That in case as a company we reorder our inventory, okay, the Q proposed by the model, then it ought to be optimal. Okay, therefore the total costs that we're incurring ought to be minimum. Okay, and instead, don't forget, that is in case the assumption of the EOQ are to be upheld. Okay, if we uphold the assumption of EOQ, then the Q proposed by the model is therefore optimal. Okay. The cost of inventory, okay, the total relevant cost of inventory or total inventory cost, okay, is made of 3 elements. We have purchase cost, we have holding cost, and of course we have ordering cost. Okay, those are the three elements of purchase cost of the total inventory cost. Okay, generally we do ignore purchase cost in case there's no quantity discount. Okay, because it does not matter what is the reorder policy, the total purchase cost remains constant. Okay, but in case there's discount, then of course we therefore include the purchase cost in our analysis, because purchase cost therefore become a relevant cost. Therefore, if there's discount, suppliers are given based on quantity. Okay. Now, this is an area where your examiner does not test that often, because most of the questions have already been tested in MA, okay, in your previous paper of MA. So let me look for a question. Look for a question that can help us out. We do a very short question. I know that it's a complex one. Just to decide on how to manage inventory. So I want us to do a very short question here. Okay, so there's a question I'm sharing on the WhatsApp platform. Okay, so that question called PKA company. I want us to redo part B. Okay, hope we have seen the question. PKA company. Okay, I want us to do part B. So go for it, then discuss together. Okay, and suppose that you're going through the question. So you've been asked to determine which of should the company adopt a new policy or not? Okay, should the company use the EOQ policy, the current policy, and what if the company can use EOQ? Okay, will there be any saving? Okay, so the current policy, the company, the Q, and the current policy is 100,000 okay units. This is done when the inventory value level is at 35,000. Therefore, the order level is equal to that 5,000 units. Okay, the forecast demand in an year, so D is equal to 625,000 units. Okay, cost of making the order, cost per order is equal to 250 euros. Euros, not dollars. Okay, then holding cost is equal to 0.5 unit per year. Okay, the orders are received 2 weeks after. 2 weeks after. Okay, that means therefore, we may determine is there what we call is there buffer stock here? Is there what we call the buffer stock? Okay, we don't know, but it's good to confirm whether there's in the buffer stock. Buffer stock is what remains of the company. What is the minimum inventory level for the company? Okay, so the company made the order when the inventory was at 5,000 units. We want to determine within these 2 weeks, okay, because they made the order today, they get 2 weeks later. So within these 2 weeks, how many units have they consumed? Will be equal to, in a year, they sell 625 units. In a year, they are 50 weeks. Therefore, in a week, therefore, the company is selling that much. Okay, for 2 weeks, we multiply by 2. Okay, therefore, the consumption within those 2 weeks was how much? 25,000.
Yes.
Okay, therefore, since they made the order when the inventory was that 5,000, then within those 2 weeks they consumed 25. Therefore, by the time they receive them, the inventory remaining therefore is equal to 10,000 units. Okay, that's referred to as the buffer stock. Okay, therefore the minimum stock for this company. Don't forget the buffer stock only affects the holding cost. Don't forget the buffer stock only affects the holding cost, nothing else. Therefore, the cost currently. So here there's no discount. Therefore, you can ignore the purchase cost. Okay. Therefore, the total relevant inventory cost, therefore, be holding cost plus ordering cost, to be equal to holding cost is therefore Q divided by 2 plus the buffer stock. We multiply the holding cost per year plus number of orders per year, D divided by Q, okay, times the cost per order. Q, the Q for this company, for this policy is 100,000. It's 100,000 divided by 2. Buffer is 10,000. The holding cost is 0.5. Number of order per year is 625,000 units. Divided by Q, 100,000. Cost per order is equal to 50 euros. And you get how much? The cost of the current policy. Don't forget, as I mentioned, I did ignore. We did not include purchase cost. Both it is constant. There's no any discount received. Therefore, that's why we have ignored it. Like, no.
$31,562.5.
Okay. For the cost, the relevant cost under the current policy. Okay. Now, what if we have a case? Now, what if we use the AOQ? That's the next question. What if we use the AOQ? And don't forget the buffer stock is remain constant irrespective of the company ordering policy. So when you use the EOQ, the buffer remains as it was. Okay. So EOQ, let's use EOQ policy. So first we get the Q will be equal to 2, annual demand, cost per order, holding cost per year. Annual demand, 625,000 units. Okay, then you'll be told that our holding cost will be equal to 0.5. That doesn't change, 0.5. So the cost per order, so it is equal to 50 euros. So times 250 euros, we divide by 0.5 to get a Q of how much?
$25,000.
25,000. Together for Q equals 25,000. Okay, great. So since the Q is 25,000, then that's the only thing that changes. Okay, therefore the cost, therefore relevant inventory cost, therefore would be equal to holding cost Q 25,000 divided by 2 plus buffer remains the same as I mentioned 10,000. Holding cost per unit 0.5 plus number of orders per year 625,000 units divided by Q 25,000 units times 250 euros. You get how much?
$17,500.
17,500. So you compare the cost before, okay, and cost after, you can see there's a saving here. Therefore, the net saving, the company, 31,533, yes, 533, 563 minus 17,500, and get saving of 14, these are euros. I get 14 and 63 euros will be the saving. Okay, therefore the company should implement the proposed policy. Okay, the company therefore should use the EOQ policy, should use the EOQ inventory ordering policy, EOQ ordering policy, since it yields an annual net saving of euros 14 and 63 euros. Clear? Question? Okay, great. That's on inventory management. Next, let's discuss on how to manage receivable. Okay, receivables management. When it comes to management of receivable, it's the same concept you want to establish, that you don't want to have a case where you have too much receivable that it does not make any profit for you. Okay, you want to ensure that the amount you invest towards the receivable, they make profit. It's an investment you're making towards your customers. They must make in profit definitely. Okay, and also at the same time you want to ensure that you do remain liquid. Okay, because every coin you invest in your customer is in quote like cash outflow. Okay, it's like a cash outflow. So in case you invest $10,000 to your customer in terms of good you sell on credit, it means it's money out you have sent to your customer on goods on credit. Okay, so definitely you want to do the math in quotes. Okay, when it comes to making sales on credit to your customers. Okay. The first thing as a company you need to establish is having a policy. Okay, you need to call a policy statement with regard to the management of account receivable. And the policy statement you need to be having, for example, you need to be having a number of things. Okay, 4 things. Okay, actually, the first thing you should be having is maybe the discount. Okay, do we give discounts? Okay, and if we do give discounts, okay, who qualify for the discount? Okay, if you give discounts, who qualify for the discount? Okay, the first thing you need to be able to establish. Okay, on that on the discount, the matter of discount. Okay, the policy also need to be discussing on the debt collection. Okay, on the debt collection. Okay. So generally, okay, the idea is that if you make a sale for 10 days, okay, if the agreed upon payment period is 10 days, then we expect, okay, or we hope for the customer, they pay us as per the agreement. But if they take longer than that, what do you do as a company? Do you call them? Okay, do you sue them? Okay, do you take them to court? Okay, do you hire an agent to do debt collection for you? Okay, so debt collection procedure, okay, need to be part and parcel of the receivables management policy statement. Okay. The other thing that need to be contained within the policy statement is the credit itself, okay, the credit extension, credit period, okay, credit period. How many days do we give to a customer? Okay, if we don't give any days, okay, we don't sell good on credit. Therefore, our policy is that as a company, we only trade on cash. Okay, the company do that. Okay, we only trade on cash basis, so there's no credit at all. Okay, but in case of this credit, who qualifies for credit, for example? Okay, who qualifies for the credits? Okay, and how many days do you give them? Okay, you give them 10 days, 30 days, 40 days. Okay, so what the period you want to give to your customer? Okay, the next thing, how do you evaluate whether a customer is worthy of credit? Okay, how do you evaluate whether a customer is worthy of credit? What we call credit worthiness or credit analysis, credit worthiness analysis, credit worthiness analysis. Okay, what do you look for? Okay, bank statement, their previous year financial statement, who are the board managers, okay, to assess their level of integrity. Okay, so all that kind of for part and parcel of the customer of the policy which you need to have as a company when it comes to extension of credits. Okay. When it comes to making comparisons, okay, with regard to whether we need to change our policy to change the policy we're adopting. So actually, you can adopt 2 policies when it comes to extension of credits. We have called a liberal policy, also referred to as a loose policy. We have called our stringent policy, a stringent or a strict policy. Okay, stringent policy or strict policy. So all of these two policies, they have their own advantages and disadvantages. Okay, what matters for now is which one is going to be yielding more benefit than the cost. Okay, which one maximizes the company benefit? Is it a liberal policy or is it a stringent policy? It's about comparing the cost and the benefit we received from the company adopting a given policy, adopting a given trade receivable policy. Okay. Now in the MOOC, there was a question which I think I gave you, which I think is asking us to do this, if I remember. The question that you're meant to do. Okay. Yes, there's a question here. So let me share the question for, I think there's some who are new here. So let me share the MOOC. So we do one more question. Okay, there goes the MOOC. Okay, so the question 3B. Question 3B was asking us to get advice whether the company revising its policy is going to be good or not. Okay, so go through the question, question 3, part B. Okay. Let's discuss together quickly. Okay, let's run through it together. Okay, so this question being asked to get the advised company on the policy. So the current policy is as follow. For information, so average day they give the customer, currently they give the customer 45 days. Okay, the sales of the company, the gross profit on the company sales currently is 25%. If, however, the company adopts the new policy, this is going to increase to 80%. Okay, annual sale is amount to 6 million. If the company adopts the new policy, the sale will increase by 40%. Okay, I think we're getting profit increase. Okay, so profit increase. The gross profit increase, not just profit, but gross profit. Okay, gross profit increase. The company current gross profit and the current policy, the gross profit you've been told is equal to if the is 25%, very high, but let's do it. So 25% of the company sales equals 6 million, to give us 4.5 million, I guess. Okay, if we implement the proposal, this is going to increase to 80%, but and the sales are also increasing by 40%. The sales are also increased by 40%. Therefore, 140% of 6 million. So is the profit of the current policy 4.5 million? profit at the current policy? Is it 4.5?
Yes, it is.
Okay. Under the proposal, how much is it?
It's 6,720,000.
Okay, so therefore it is increasing. So there was an increase, therefore, which is a benefit to the company. 2 million to 20. Confirm. Increase in gross profit, 2 million to
Yes.
20. Okay, great. 2 million to 20 because of the increase in the company gross profit. Okay, that's good. Then there'll be, okay, amount sales. The number of days currently it's 45. If the company implements this proposal, this will decrease to 30. Okay, so the days are decreasing. So if the days are decreasing, then that's something good for the company. Receivables investment. Okay. Current policy, the receivable investment is equal to, okay, you can say the current policy is equal to, so current policy. The number of days you give your customer on average is equal to 45. Therefore, 45 days out of the number of days in a year. How many days in a year do we use? It's not given to us. So use the 60. Okay, use the 60, not given to us. The 60, we multiply by the sales the company is making on credit. We have 80% of the company's sales currently, they are on credit. Therefore, 80%, we multiply by the current sales, 6 million. Give us how much? With the current company investment in the receivable.
$600,000.
Okay, 600,000. If we implement the proposal, the number of days will be the average number of days will be 30. Therefore, 30 out of 360, we multiply by the number of the current receivable, which is equal to 60% of the company sales will be on credit. 60%. So what's the current sales? I think we should not have done. This is the current sales. What's the current sales? No, what's the sales under the proposal?
8.4 million.
Proposed sales. This is 8.4 million.
Yes.
Okay, therefore we multiply by 8.4 million. So it's sure therefore the proposal will be how much?
For 20,000.
For 20,000. So since there's a decrease in the amount by 180,000, that means therefore you again be borrowing less money from the financier. Therefore, there be interest cost, therefore interest saving, therefore will be equal to the person who finances you charges you how much? 12% per year. Therefore, the interest saving, therefore 12%, we multiply by 180,000. The decrease in the amount you borrow from them. Therefore, how much is the saving per year? $21,600.
Yeah. 21,600.
Okay, 21,600 because therefore the interest cost saving. Okay. This is maybe have not done. Bad debt. Okay, bad debt. Okay, that's clear on the bad debt. Okay, on the bad debt, you've been told that the current bad debt is 3% of the sales on credit. Therefore, the current policy, the bad debt is 3% of the sales on credit. The current sales on credit is equal to 8% of 0.8 times 6 million. Proposal, which they say that the proposal, the bad debt expense will increase to 5%. There are 5% times, okay, the sales on credit, which is equal to 80% of 8.4 plus 60% of 8.4. So current bad debt is how much, therefore? Current bad debt, 3% of 4.8 million.
14,400.
14,400.
Yes.
14.
I'm
Sorry,
44.
sorry, I lost you.
144,000.
Oh, 144,000. Okay. And that's the current policy. Proposal goes to be the bad debt expense.
$252,000.
So this is the bad debt expense. The company is increasing from 144 to 54, which is 106 or 108.
108.
Okay, therefore the company bad debt expense is increasing. Okay. The company will also give their customer discounts. Okay, so we told that the terms are 515 net 45. All credit customer will enjoy the 5% discount subject to the terms. Okay, so you can be able to get the discount. Okay, the 5%. So the question is, what will be among the customer who pay within 15 days? Okay, first you'll be told that the customer, the number of days for the customer on average will be 30 days. Okay, so therefore average days for the customers, the days for receivable is 30, and you have two customers. The one who pay within 15 days, they get a discount, and the other don't get the discount. However, they're meant to pay within 45 days. Okay, therefore, on average, is given us 30 days is equal to the one who pay in 15 days. Okay, which we don't know what percentage they are. Okay, let me just call it X percent, plus the one who pay in day 45, we don't know, but they'll be equal to 100 minus X percent, isn't it? Okay, let me just use this to be a ratio, just to be a decimal, okay, to make it sense. It'll be therefore 1 minus X, isn't it? Is it clear? The average of 30 is the two combined. Okay, the average is of 30. There are two customers who combine, the one who pay in day 15 and the one who pay in day 45. Is that clear first? 30 days is the average. And you have two customers, the one who pay in day 45 and the one who pay in day 15. Don't forget 515 net 45. 515 net 45. What does it mean? It means you get 5% discount in case you pay within 15 days. However, you meant to pay in day 45. So the one who get the discount, they pay within 45 days. Otherwise, they pay in day 45. Clear? There's someone who said no. So is it clear? You went quiet, and I want to decide whether you understood the concept or not.
Yes, clear.
Okay. So what that means therefore is that the ratio or the percentage of those who paid in day 45, day 15, we don't know. So just give another variable here, X. The one who pay in day 45 is a balance because they only two customers. This which therefore will be equal to 1 minus X, 100 minus X. Clear there? Okay, great. Therefore, we want to get the X now. Okay, which is the unknown? 15X, okay, plus 45 minus 45. X is equal to therefore 30. Therefore, this gives minus 30. X is therefore equal to 15. Okay, minus 15. X therefore is equal to 0.5. Therefore, half the customer pay in day 15, half pay in day 45. Now, the one who therefore get a discount are the one who they are 50%. Okay, therefore discount to customer, therefore discount cost to the company therefore be equal to half of the customer who bought on credit. Okay, the half of the customer are the one who going to get the discount, and half of the customer who are going to be buying on credit. There is the value, 60% of 8.4, which was how much actually? The total sale on credits are the new policy. Credit sales was how much? 6% of 8.4. 4 million. Okay, 5 million.
5,040,000.
5 million and 40,000. Okay, they have half of this.
Yes.
They have half of this customer who pay. They pay in the 15 and they get a discount. Therefore, half of this customer is 3%, which is 50, 40. And they're going to get in 5% discount, therefore times 5%. Clear? Okay, great. Therefore, how much discount therefore do you give to your customer? $130. Actually, 120 something. 120.
126.
106,000. Okay, because therefore the discount you're going to give therefore to your customer. And I think we are done with the question, I guess. Anything else remaining? Part-time, you'll be paying a part-time consultant. That is it. Okay, that is it. So therefore the analysis here. Okay, so we can begin the savings. Then you have the cost. So there's saving, which you have saving here. Budget is increasing. Interest saving, I think I'll begin there. Interest saving, 21,600. Interest cost saving, 21,600. Interest saving that you have, interest saving, we have increase in gross profit by 2.2 million. Gross profit increase is equal to 2 million to 20,000. And that is it. Okay, total saving therefore will be equal to 2 million 241,600. Then you have cost here that will come with the policy. First, we have increase in bad debt, budget expense, okay, which we got to be equal to 8,000. Then we have a discount cost. We have just done right now. Discount cost, okay, which is equal to 106,000. And the cost that comes in, bad debt, okay. Okay, then you need to pay admin. This you need to hire a consultant, okay, for salary of, let me call this is consultant cost, 500,000. Okay, and the next remaining, that is it. Okay, and you get how much to be the gross savings, the weekly savings. So we got the, of course, the net saving. Okay, so 2.2 million minus 1.8 plus minus all these other costs. You get how much?
$1,507,000.
1,507,600.
600.
600. Dog, these are gross saving. Dog, since you made a saving, you have to pay to KRA some money, tax on the saving you have made. 30% because for the tax. Okay, how much tax therefore do you pay? Dog, I've done here the tax because there's a tax given there. Okay, otherwise don't assume. If there's no tax given, don't assume there's a tax. $400.
452, 280.
Okay, therefore your net saving therefore is how much?
$1,055,320.
Okay, is it a good policy? Of course, the company should implement. The company, okay, should implement the proposed changes. Should implement the proposed management policy, receivable management. The proposed policy changes. Okay, since the yield. Sorry. Someone was talking. Yeah, that is it. That's the amount of running that particular question. Okay. Clear? Question? Okay, no question. Therefore, we meet on Wednesday. And I think Wednesday is our final class. Okay, I think we only have two days for revision. So don't forget, in case you have any question that is pending, don't forget to come with it on Wednesday so that we can able to revise it and revise it well. Okay. That's fair enough. We meet on Wednesday. I think we can do one more question from the receiver management because that's the area where you examine more often than not the normal test. So I think we can do another question on Wednesday. Okay. Then see you on Wednesday. Enjoy your evening.